May 2024. Here Solution prepared a draft income statement for the year ended 30th April 2024, which showed a profit for the year of £19,000. The business was aware that there were some errors in the books of account. On further inspection, the following errors were discovered in the books of accounts. As you can see here, you have 5 types of errors. Required. Explain the term error of principle. Explain the term suspense account, 2 marks each. Part B. Prepare the journal entries to correct the errors, 10 marks. Complete the table in the question paper showing the corrected profit after the corrections of all errors, 10 marks. Part D. Evaluate the use of international accounting standards when preparing financial statements. For this question, 30 marks in total. Now, let's go through each type of error and how we conclude with the journal entries. Error number 1. Credit purchases costing 7,100 had been correctly posted in the supplier account but has been recorded in the purchasers account as 1,700. So let me keep the calculator open. Right. Now let's see what should be the correct entry in order to record credit purchases of 1,700. So you debit purchases account by 7,100 and you credit trade payable supplier account by 7,100. Now what was the error? It has been correctly posted in the supplier account. That means in the trade payable account it's correctly entered. However, it has been recorded as 1,700 in the purchasers account. So in the purchasers account, it debited 1,700 instead of 7,100. Therefore, it's been understated. So 7,100 take away 1,700 should give 5,400. So let's correct this error. Therefore, you have to add the purchases account by 5,400 on the debit. You do not know where to credit it. Therefore, you credit in the suspense account by 5,400. Now, we can conclude the double entry. Therefore, purchases account debit, suspense account credit by 5,400. Error number 2. The owner of your solution had been paid 30 per week, which had been paid and posted to general expense account for 52 weeks of the year. First, let's calculate the total amount. So it's £30 for 52 weeks. That should be 1,560. Now, let's see the double entry for the original entry. The owner of your solution had been paid. That means the business has paid the owner, means it's drawing. Therefore, debit drawings account by 1,560 and you credit the cash book by 1,560. Now, what's the error? Instead of entering it in the drawings account, they are posted it in general expense. Therefore, the error is general expense, they are debited. However, they haven't made any errors in the cash book. Cash book is correct, credited by 1,560. So no changes will be required in the cash book. However, you have to add in drawings account, remove it from general expense account. Therefore, in order to correct this error, drawings debit by 1,560, credit general expenses by 1,560. Therefore, let's conclude the double entry now. Drawings debit, as you can see here, drawings account debit and credit general expense account. Error number 3. Commissions receivable at the rate of 2.5% of £30,000 sales had been recorded in the cash book, but no other entry has been made in the books. So it's error of omission. First, let's calculate the amount. So it should be 30,000 into 2.5%, which should give 750. So let's write the amount first. So 30,000 into 2.5% equals 750. The correct entry should be cash book debit by 750, credit commissions receivable, since it's an income. What was the error? Had been recorded in the cash book. That means in the cash book it's entered, but there is an omission in the commission receivable account. They forgot to credit it. How are we going to correct this error? Therefore, you have to include it in commission receivable. 750 credit. We do not know where to debit. Therefore, suspense account debit by 750. Therefore, the double entry sales account debit, suspense account debit, and then we're going to credit commissions receivable. Error 4. Depreciation on office equipment had been charged for the year using reducing line method, which had been calculated. They've calculated depreciation using reducing line method, which gave a value of 350. This should have been charged 20% using straight line method on the office equipment cost 3,000. That means they have used the wrong method to calculate depreciation. First, let's calculate the straight line method depreciation. Therefore, 3,000 into 20% should give 600. However, they have used a different method and the value was 350. Now, what should be the original entry? Income statement, you should debit 600. Provision for depreciation should be credited by 600. What was the error? They have entered in the income statement 350, credited provision for depreciation by 350. Now you have to bring back to the original entry. So you can see it's understated. So in order to correct this error, 600 take away 350, 250 should be added to both the accounts. Therefore, income statement debit 250, provision for depreciation credit by 250. Income statement debit and then credit provision for depreciation. Error number 5. The allowance for irrecoverable debts, or we call it provision for irrecoverable debts, on 1st May 2023 of £3,450 was not adjusted at the year end. The balance of the trade receivables at 30th April 2024 was £80,000, and for your solution estimated that 3.5% of debt would become irrecoverable. Estimated figure means it is the calculation for provision or allowance for irrecoverable debt at the end of 2024, 30th April 2024. Now let's calculate for the year end. So it should be 80,000 into 3.5%. 2,800, and at the start you had 3,450. That means it has reduced. So 3,450 take away current year 2,800, that's reduced to 650. The correct entry should be provision for irrecoverable debt or allowance for irrecoverable debt should be debited by 650. Income statement should be credited by 650. The error that they have made is they haven't entered this in the books. So we're going to correct the error. We have to bring it back to the original entry. So in order to do this, provision for irrecoverable debt debit or allowance for irrecoverable debt debit 650, and credit income statement by 650. Okay, for the double entry, provision for irrecoverable debt debit, and then income statement credit by 650. Now we had finalized with the journal entries. Now let's see how this will have an impact in the corrected profit. As we read the question before, we already had the drafted profit, which is given in the question 19,000. Now we have to see how each transaction will have an impact in the income statement. Let's look at the first one. As you can see here, purchasers is debit. So purchasers increasing. Purchasers increase means what will be the impact on cost of sales? Take a minute to think. So cost of sales would increase. If cost of sales increases, what will be the impact on profit? It will decrease. So purchasers, you decrease it by 5,400. Next entry, drawings debit, general expenses credit. General expense, it's reducing. That means expenses reducing. If expenses reduce, what happens? It will increase the profit. Next one, suspense debit, commissions receivable credit. Commissions receivable credit, it's increasing. Therefore, other income increases. So if other income increases, what happens to the profit? It should increase. So commission receivable increase 750. Next, income statement debit, provision for depreciation credit. Provision for depreciation has a credit balance. If provision increases, that means the expenses will increase. If expenses increase, the impact would be, it will decrease the profit. Allowance for irrecoverable debt debit, income statement credit. That means there is a decrease in allowance for irrecoverable debt. This would increase other income. If other income increases, the impact on profit would be increases profit. Now let's add up 1560, 750 and 650. It should give a total of 2,960, which the total to be added, and decrease 5,400, 250, which should be 5,650, which needs to be deducted. Therefore, 19,000 plus 2,960 take away 5,650 should give the corrected profit of 16,310.